Assalamu alaikum. Good morning, Dr. Muhammad. I am Abdurrahman Fahad. My presentation today about distinguish between an assist and stock acquisition. Assist purchased. Assist sales generally do not include cash, and the seller typically retain the long-term debt obligation. This is commonly referred to as cash-free, debt-free transaction. Normalized net working capital is also typically included in a purchase agreement. Net working capital often includes accounts receivable, inventory, prepaid expense, account payable, and accrued expense. Now we'll talk about the stock purchase. The acquirer buys all the stock of the target and takes the corporations as it finds it. All of the target corporation's assets remain subject to all its liability. Most contract, lease, and franchise right and permanents remain in place, although some substantiated pre-existing agreements with third party may require their consent to continuation after transfer of control of the corporations. Now we will talk about the advantages of an assist purchase compared to stock purchase. In assist acquisitions, the buyer is able to specify the liabilities it is willing to assume while leaving other liabilities behind. In stock purchase, on the other hand, the buyer purchases stock in company that may have unknown or uncreated liabilities. By purchasing assets rather than stock, the buyer avoids the problems presented by minority shareholders who refuse to sell their shares. Now we will talk about the disadvantages of an assist purchase compared to stock purchase. It is necessary for the selling company's assets to be regulated in the name of the buyers. This is not required in the stock transaction. In states that impose sales or transfer tax on the sale of assets, a stock transaction can avoid some or all of these taxes that apply in the event of an assist transaction. Why an assist sale? The two most important reasons that buyers purchase only the assets of the business are liabilities, depreciations. The first one is liabilities. The definition of liabilities: if you buy the stock of the seller corporation, you are stuck with and have to pay all of its liabilities, known and unknown. If you don't, you could lose the business. If you buy just the assets of the business at arm's length, you can take over the business but avoid most of the liabilities. The liabilities have to be paid by the seller before it's distributed the money to its shareholders. Well, otherwise, the creditors can go after the shareholders for the money they received from the seller. So, if you pay a reasonable price for the business, you don't have to worry about the lawsuit coming up a week after you take over the business. If it does, it's the seller's problem. Some liabilities cannot be left behind even in an assist purchase. For example, you can be liable for certain environmental claims, and any claims that are liens on the assist you just bought must be satisfied, or you could lose this assist. Now we will talk about the depreciations. The definition of depreciation is the right of the business to deduct from its income each year a portion of the cost of its tangible asset. It is permitted to allow the business to recover a portion of the cost of the replace the assist. So, in simple terms, if the restaurant purchase pizza oven with a 7-year useful life for 49,000, the business can deduct 7,000 from its income each year for 7 years. This way, the business will, in theory, have 49,000 to purchase a new oven when its one wears out. Now, the oven will probably continue to work after it has been fully depreciated. But that doesn't matter, it only means the business cannot take the depreciation deductions. So, if there is a large amount of furniture, fixtures, and equipment used in the business, the deduction can be subsistent. Depreciation is basically tax-free income for the business, and in some cases, the tax law allows a business to accelerate the depreciation deduction or take it all in 1 year. Why stock sell? So, why does any buyer agree to stock purchase? First, if there are contracts or licenses that make up a big part of the business purchase, the business sale can often be made without notifying the other party. Second, if the seller can demand a stock sale and be unwilling to consider an assist sale, then if the buyer wants the business badly enough, he will have to buy the stock to make it happen. Thank you. This is my presentation and this is my references. Thank you for your listening and see you.